The latter bottom pattern is recognized as a bullish reversal signal in the world of trading, indicating a potential shift from a downward trend to an upward trend. While unique in its formation, there exist variations and patterns that carry a similar bullish reversal sentiment, but are distinct in their structural appearance. Notably, the hammer and the inverted hammer patterns are such examples that investors might encounter. Both the hammer and the inverted hammer are single candlestick patterns, unlike the ladder bottom, which is composed of multiple candlesticks. The hammer pattern is characterized by a small body at the upper end of the trading range with a long lower shadow and little to no upper shadow, resembling a hammer. It indicates that even though selling pressures were present, ultimately buyers were able to push the price back up, suggesting a forthcoming reversal in the downward trend. On the other hand, the inverted hammer also signals a potential bullish reversal. It appears similar to the hammer, but with the small body at the lower end of the trading range and a long upper shadow. This pattern suggests that buyers attempted to take control during the trading period, pushing the price up, but faced resistance at higher levels. However, the important takeaway is the buyer's presence, which could foreshadow a change in market sentiment from bearish to bullish. Understanding these variations is crucial for traders as it expands their capability to recognize early signs of market trend reversals. It requires a familiarity with a broad set of candlestick patterns and a keen eye for detail to differentiate among them. Each pattern, while carrying a similar overarching theme of potential bullish reversal, presents in a unique structure, offering insights into the ongoing psychological dynamics between buyers and sellers in the market. The matching low pattern is a bullish reversal sign that appears during a downtrend, suggesting a potential shift towards an upward trend. Essentially, it is identified by observing two consecutive candlesticks on a chart. These candlesticks have their lowest points at the same or nearly the same level. This pattern is significant because it implies that despite the selling pressure, the price failed to push lower on the second candlestick, indicating a possible resurgence of buyers. In other words, when we see this pattern forming, it indicates that the market's sentiment may be changing. Sellers who were previously driving the price down are now encountering a strong enough demand at a specific price point, preventing further decline. This stabilization at a low point suggests that buyers are beginning to regain control and that the market could be on the cusp of moving upwards. Understanding this pattern does not require deep technical knowledge, but it's important to recognize its potential implications. When investors and traders see a matching low pattern, they might consider it an opportune time to enter the market, anticipating a bullish reversal. However, caution is advised, as with any trading decision, and it's often recommended to look for additional confirmation signals before making a move based on this pattern alone. In summary, the matching low is a hopeful sign for those looking for a market turnaround. It represents a pause in a downtrend with the potential to reverse into an uptrend, signaling a shift in market dynamics where buyers are starting to outweigh sellers at a critical price point. The matching low is a bullish reversal pattern that appears during a downtrend. It is characterized by two consecutive black or red candles. These candles are notable for their matching lows, meaning the lowest price point reached by both candles is the same. The significance of the second candle not closing below the low of the first candle suggests a pause in the downward momentum. This pause indicates a possible decrease in selling pressure, leading to a shift towards more bullish sentiment among investors. The pattern hints at the potential for a change in market direction, from a downtrend to an uptrend, as buyers begin to gain control. Understanding and identifying this pattern can be valuable for investors looking to capitalize on early signs of a market recovery. The matching low pattern emerges in financial charts as a hint that the downward momentum in the market might be slowing. This pattern is characterized by 2 consecutive trading sessions where the price is close at nearly the same low point, without significant recovery in between. It visually suggests that the market sentiment is shifting, indicating a period of equilibrium where neither buyers nor sellers have definitive control. This equilibrium is significant because it implies a pause in bearish downward momentum. This pause is critical to understand. During the first session of a matching low, sellers dominate, pushing the price down. However, by the end of the second session, the repeat of the low closing price without further decline suggests that sellers are no longer driving the price down with the same force. This stabilization implies that sellers are losing their grip on the market and that buyers are starting to resist further declines, showing signs of growing strength. The matching low does not guarantee a reversal from a bearish to a bullish market where prices start to climb. However, it signals a potential change in market sentiment. Traders and investors watch this pattern closely because if buying interest increases following the appearance of a matching low, it may indeed lead to a bullish reversal. The matching low, therefore, acts as an early signal that the bearish trend might be losing momentum, offering a window of opportunity for those monitoring the markets closely and looking for signs of changing trends. Understanding the matching low pattern can assist in making more informed decisions about when market dynamics might be shifting from favoring sellers to indicating potential strength among buyers. It's like noticing the first rays of dawn after a long night, hinting that the sun might soon rise. The matching low pattern is identified as a bullish reversal pattern, which suggests a shift from a downward trend to an upward one. This pattern becomes significant particularly when it is followed by a confirmation. It occurs in the context of a stock or market that has been experiencing a decline. The key feature of this pattern is the appearance of 2 consecutive candlesticks on a chart, with each having the same or very similar low points, but not necessarily the same high points. The similarity in the lows indicates a strong level of support at that price level, suggesting that the market is resisting further declines. When we observe this pattern, it signals that selling pressure may be diminishing and a reversal could be on the horizon, marking a transition from bearish to bullish sentiment. However, for the matching low pattern to serve as a reliable signal for a potential upward movement, it needs to be validated by subsequent trading activity. This means looking for signs of increasing buying pressure following the formation of the pattern, which could include a higher closing price on the next trading day or an increase in trading volume. It's crucial for investors and traders to look for this confirmation because, without it, the pattern alone may not provide a strong enough indication that the market's direction is about to change. Once confirmed, the matching low pattern could be considered a compelling reason for considering an entry into a position with the expectation that prices are more likely to head higher than they are to continue falling. Confirmation of a matching low pattern, considered a bullish reversal indicator, involves several critical factors. First, one might observe an increase in trading volume on or right after the appearance of the second candle in the pattern. This increase in volume is a strong signal that buyers are entering the market with conviction, supporting the potential reversal indicated by the pattern. Additionally, the presence of other bullish candlestick formations following the matching low pattern can further validate the bullish reversal. These could be patterns such as a bullish engulfing or hammer, which also indicate buying pressure and a potential change in market direction. Finally, a break above resistance levels after the formation of a matching low can serve as another layer of confirmation. Resistance levels are prices at which an asset has had difficulty rising above in the past. A break above such levels after a matching low pattern suggests that the market sentiment is shifting in favor of the bulls, with potential for further upside. In essence, the combination of increased volume, subsequent bullish patterns, and a break above resistance levels strengthens the case for a market turnaround as signaled by a matching low pattern. These factors, when occurring together, provide a more robust confirmation of the bullish reversal, offering traders and investors a firmer basis for making decisions. The matching low pattern is an important signal for traders, indicating a potential bullish reversal in the market. This pattern is recognized when the price of an asset hits a low point on 2 consecutive sessions, with the second low approximately equal to the first, suggesting strong support at this level. However, the reliability of this indication of market reversal grows when it is not viewed in isolation. To increase confidence in the prediction that a bullish reversal is indeed imminent, traders often combine the matching low pattern with other technical indicators. These can include moving averages, RSI, relative strength index, or MACD, moving average convergence, divergence, among others. The logic behind this approach is to look for confirmation from multiple sources, reducing the risk of basing decisions on what could be a temporary consolidation within an ongoing downtrend. In essence, while the matching low pattern on its own provides a hint towards a possible change in direction from bearish to bullish, its true strength comes from being validated by additional technical indicators. This combination helps in sifting out false signals, thereby enabling traders to make more informed decisions with a higher degree of confidence. To enhance the predictive power of the matching low pattern, an investor can integrate it with several technical analysis tools. A matching low pattern is a bullish reversal pattern indicating that the market may be changing direction from a downtrend to an uptrend. To confirm this potential reversal and make a more comprehensive market analysis, one can combine the matching low pattern with the following tools. First, RSI divergences can be an effective addition. The Relative Strength Index, or RSI, measures the speed and change of price movements. A divergence occurs when the RSI direction differs from the price direction, indicating a potential reversal. If an RSI divergence occurs near the time a matching low pattern is identified, it may reinforce the signal for a bullish reversal. Second, MACD crossovers offer another layer of confirmation. The moving average convergence divergence, known as MACD, is a trend following momentum indicator. A bullish crossover occurs when the MACD line crosses above the signal line, suggesting that upward momentum is increasing. If a MACD crossover accompanies a matching low pattern, it strengthens the case for a trend reversal. Finally, support levels identified through Fibonacci retracements can provide critical price levels to watch. Fibonacci retracements are used to identify potential support and resistance levels based on previous market movements. If a matching low pattern forms near a key Fibonacci support level, it may indicate a strong area where the market could bounce and start an uptrend. By combining the matching low pattern with RSI divergences, MACD crossovers, and Fibonacci retracement levels, an investor can conduct a more thorough and reliable analysis. This integrated approach allows for better decision-making by confirming bullish reversal signals through multiple technical indicators. One common mistake traders make when they encounter what they believe to be a matching low pattern is acting on it without waiting for further bullish confirmation. This can lead to a premature entry, which might not always be fruitful. The matching low pattern, a bullish reversal setup, involves two candlesticks showing similar lows in a downtrend, indicating potential for a market turnaround. However, it's important for traders to be patient and look for additional signs that confirm the reversal is truly underway. Without this confirmation, it's risky to assume the trend will reverse just based on the presence of two similar lows. Further bullish confirmation might come in the form of a closing price above the matching low formation or other indicators suggesting upward momentum. Additionally, traders should be cautious not to confuse similar patterns with the actual matching low configuration. In the world of technical analysis, many patterns may look alike, but the details and the conditions under which they form can differ significantly. Mistaking one pattern for another can lead to erroneous trading decisions. Thus, it's crucial for traders to familiarize themselves with the specific criteria that define a matching low pattern to recognize it accurately. This includes understanding the typical market conditions under which this pattern forms and the subsequent price action that validates it as a signal for a bullish reversal. In summary, to effectively leverage the matching low pattern, traders should ensure they are correctly identifying the pattern and wait for additional bullish indicators before taking action. This careful approach helps mitigate risks and increases the chances of capitalizing on potential market reversals. When you come across a matching low pattern in the market, it is often seen as a sign that the market could be gearing up for a bullish reversal. This pattern is characterized by two consecutive candlesticks that close at roughly the same price, hinting at the end of a downward trend. Following the appearance of a matching low, it is wise to look for a bullish confirmation before entering a trade. This confirmation could come in the form of a strong bullish candle or a gap up, signaling that the buyers are taking control and that the price might start to move upwards. For deciding on exit points or setting targets for your trade, it is prudent to consider the upcoming resistance levels. These are price levels where the asset has previously faced selling pressure, making it a challenge for prices to rise beyond these points without significant buying force. Planning your exit around these resistance levels can help in securing profits before the price potentially pulls back. Another approach is to use a predetermined risk-reward ratio, which involves setting your target profit at a point that justifies the risk you took on the trade. For example, if you are risking 10 points on a trade, you might set a target that offers a potential return of 20 points, giving you a risk-reward ratio of 1:2. Both of these strategies for setting entry and exit points require careful consideration of market signals and an understanding of how price levels have behaved in the past. By incorporating these methods into your trading plan, you can make more strategic decisions that align with the market's momentum and your own risk tolerance.